Securing early-stage funding is a critical milestone for any startup, but the terms of that investment can make or break your company's future. A well-structured seed investor agreement protects both founders and investors while setting the stage for growth. A seed investor agreement is a document that specifies the terms and conditions of an investment in an early-stage company. These agreements typically range from 1 to 5 pages and are generally non-binding, except for specific clauses related to confidentiality or exclusivity. When crafting a seed investor agreement, several vital clauses must be included. First is the investment structure, which usually takes one of 3 forms: common shares, convertible preferred shares, or convertible debt. With common or preferred shares, the company is valued immediately, setting a specific price for the investment. Convertible debt, however, functions as a loan that later converts to equity, often at a more favorable valuation during a subsequent funding round. Economic terms form another crucial element of these agreements. This includes determining how much of the investment returns to seed investors before other shareholders receive payments, as well as defining whether returns accrue through dividends, shares, or interest that converts to debt. The investor's position within the company must also be clearly defined. Many seed investors request board representation, typically in an observational capacity, rather than direct involvement in day-to-day decisions. Most seed investor agreement templates include several standard provisions. Valuation caps and discounts apply to convertible notes or safes, limiting the maximum valuation at which the investment converts to equity or providing a percentage reduction on future share prices. Liquidation preferences outline what investors receive if the company is acquired or liquidated, with seed investors typically receiving their investment back before common shareholders. Board participation rights may grant investors the ability to appoint a board observer or member, while information rights ensure investors receive regular updates on the company's financial health and operations. Pro rata rights allow seed investors to maintain their ownership percentage in future funding rounds. A most favored nation clause ensures that if better terms are offered to later investors, seed investors can opt into those terms. Founder vesting schedules may be included to ensure long-term commitment, and anti-dilution protection can adjust share conversion prices in the event of a down round. From a founder's perspective, several considerations are important when drafting a seed investor agreement. Remember that seed investors believe in you and your business, so maintaining good communication is essential even when challenges arise. Avoid relying on a single investment source and use initial funding to attract future investments. Be mindful that the rights granted to early investors will have long-term consequences. Create a structure that accommodates multiple investors while preserving your decision-making authority. Above all, recognize that personal communication often matters more than contractual terms. Honest dialogue between founders and investors maximizes the chances of successful collaboration. While templates provide a useful starting point, customization is often necessary. Adapt language to comply with local laws and regulations. Include clear definitions of key terms like qualified financing or change of control to prevent ambiguity. Specify triggers for conversion if using convertible instruments, and outline what happens in various exit scenarios such as acquisitions or IPOs. Address intellectual property concerns by ensuring founders have assigned IP to the company, and include provisions addressing founder departures to protect investor interests. These customizations help align expectations and reduce the risk of future disputes. Several misconceptions exist regarding seed investor agreements. Some believe standardized agreements are discouraged by lawyers to maintain their relevance, but in reality, complex clauses serve to prevent future issues. While parts of legal documentation are becoming more accessible, the law remains complex, and professional guidance is invaluable. Another misconception is that a standardized agreement alone will convince investors to fund your startup. Quality investors focus more on the business potential than the agreement structure, and many appreciate convertible debt arrangements despite common prejudices against them. Templates are most appropriate when raising small rounds from friends, family, or angel investors, when ensuring consistency across multiple seed investments, or when needing a quick, low-cost method to formalize terms before a larger funding round. However, avoid relying solely on templates when dealing with institutional investors or venture capital firms, when complex terms like performance milestones are involved, or when you lack familiarity with legal terminology. Even with a solid template, consulting a qualified startup attorney is highly recommended to tailor the document and avoid potential pitfalls. A well-crafted seed investor agreement balances protection for both parties while establishing a foundation for growth. By understanding key terms, customizing templates appropriately, and seeking professional guidance, founders can secure early-stage funding without compromising their long-term vision or control.